This is the zero-interest financial cheat code that built Warren Buffett's multi-billion-dollar empire. Car insurance is one of the very few businesses on Earth where millions of customers hand over cash up front for a product they hope to never actually use. Every single month, tens of millions of drivers transfer monthly premiums into a central corporate balance sheet before a single dollar of claims expense is paid out. This creates a massive pool of unearned capital sitting in corporate bank accounts between the moment premiums are collected and the moment claims are settled. In corporate finance, this vast, interest-bearing pool of collected money is known as the float. Because policyholders pay premiums in advance, the insurance company effectively borrows billions of dollars from its own customers at a 0% interest rate. While waiting for drivers to get into fender benders, insurance executives invest this vast float into safe, liquid, income-generating assets. A massive portion of this float is deployed directly into high-yield, short-term treasury bills, corporate bond portfolios, and dividend-paying equities. Consequently, an auto insurance company operates two completely distinct profit engines under one roof: underwriting operations and asset management operations. Even if an auto insurer breaks completely even on its daily underwriting, paying out as much in car repairs and medical bills as it collects in premiums, it generates staggering net profits purely from the investment yield on its float. However, calculating how much cash to collect requires extreme mathematical precision. Actuarial scientists use advanced statistical models analyzing billions of historic driving miles to calculate the exact probability of an accident occurring. If an actuary underprices risk, a single unexpected storm or accident spike can trigger sudden corporate insolvency. Conversely, if an actuary overprices risk, price-sensitive consumers immediately defect to cheaper competing carriers. To measure whether an auto insurer is actually making or losing money on its core operations, executives monitor a single master metric: the combined ratio. The combined ratio is calculated by adding an insurer's loss ratio to its expense ratio and dividing the sum by total earned premiums. The loss ratio represents the exact percentage of collected premiums paid out directly to body shops, tow trucks, policyholders, and hospital emergency rooms. The expense ratio measures the corporate overhead required to run the enterprise, including marketing campaigns, sales commissions, executive compensation, and software servers. If an insurance company operates with a combined ratio of 92%, it retains 8 cents of pure underwriting profit on every single dollar of premium collected. However, if the combined ratio creeps up to 104%, the company is losing 4 cents on every policy written and is kept alive entirely by its investment float yields. In hyper-competitive state markets, intense price wars frequently force combined ratios well above 100% for years at a time. When underwriting losses mount, insurance companies are forced to file rate hike petitions with state insurance commissioners to restore profitability. Once a policy is active, an insurance company's ongoing margins face nonstop pressure from modern vehicle engineering. Decades ago, a simple low-speed rear-end collision required replacing a $200 steel bumper. Today, that exact same fender bender requires replacing ultrasonic parking sensors, blind spot radar grids, and millimeter wave cameras embedded in the bumper. A repair that used to cost $500 now tops $4,000 because fragile electronic sensors must be replaced, wired, and digitally recalibrated in specialized diagnostic bays. Furthermore, modern vehicle bodies are constructed from lightweight, ultra-high-strength aluminum and carbon fiber composites. Unlike traditional sheet metal, these specialized materials cannot be hammered back into shape. Entire structural body panels must be cut out and completely replaced. This dramatic rise in average repair cost per claim, known in the insurance industry as loss severity, has completely reshaped auto underwriting economics. Compounding these hardware costs is a severe shortage of certified collision repair technicians, driving shop labor rates to record highs. To suppress these runaway claim payouts, insurance carriers maintain sprawling networks of direct repair shop partnerships and deployment fleets of in-house claims adjusters. While physical metal and plastic repairs are expensive, medical payouts and legal fees represent the most dangerous, unpredictable line items on an insurer's balance sheet. A single severe multi-vehicle highway collision can result in spinal injuries, traumatic brain injuries, and millions of dollars in emergency surgery costs. To protect against these catastrophic liability exposures, insurance policies set strict coverage caps, such as $100,000 per individual or $300,000 per accident. However, personal injury attorneys actively search for technical grounds to bad faith the insurance company and breach those policy caps. If an attorney proves the insurer unreasonably delayed a valid settlement claim, the court can smash the policy limit, forcing the insurance company to pay unlimited multi-million-dollar jury verdicts out of corporate reserves. This phenomenon, known as legal system abuse or social inflation, forces insurance companies to maintain massive internal legal defense funds and specialized fraud detection units. In addition, insurers utilize medical audit algorithms to scrutinize every hospital invoice line by line, stripping out inflated medical billing before paying claims. Even an insurance company with flawless actuarial pricing and low daily claims can be wiped out overnight by extreme geographic events. Consider what happens when a sudden severe hailstorm, hurricane, or flash flood hits a major metropolitan area containing 500,000 insured vehicles. In a matter of 20 minutes, tens of thousands of vehicles suffer shattered windshields, dented roofs, or total loss flood destruction simultaneously. If an insurer had to pay 50,000 total loss vehicle claims at once, its cash reserves would be completely liquidated, driving the firm into immediate bankruptcy. To prevent this catastrophic insolvency, primary auto insurers purchase insurance policies for themselves through a mechanism called reinsurance. Primary insurers cede a percentage of their monthly customer premiums to global reinsurance syndicates, such as Swiss Re or Munich Re. In exchange, the reinsurer agrees to step in and pay all claims that exceed a designated loss threshold, such as absorbing all losses above $200 million for a single storm event. By transferring these extreme tail risk events to international capital markets, primary insurance companies insulate their corporate balance sheets against climate volatility and localized disasters. The ultimate competitive moat in a modern auto insurance industry is no longer branding or catchy television commercials. It is data density. Historically, insurance pricing was based on crude demographic proxies like a driver's age, gender, marital status, credit score, and home zip code. However, mobile smartphone telematics apps and factory-installed vehicle connectivity have completely revolutionized how risk is underwritten. Insurers now monitor real-time driving behavior directly, tracking microdata points like hard braking events, rapid cornering, late-night driving, highway speed consistency, and smartphone touch interactions while moving. Drivers who opt into telematics programs receive initial discount incentives, while allowing the insurance carrier to build ultra-accurate predictive driver profiles. This allows high-tech insurers to cherry-pick the safest drivers with discounted rates while aggressively surcharging or dropping high-risk, distracted drivers. As vehicle automation evolves towards self-driving technology, legal liability will gradually pivot away from human driver error and toward automobile manufacturer product liability. However, until fully autonomous fleets completely dominate global roadways, the insurance companies possessing the most sophisticated telematics algorithms will control the most profitable financial balance sheets on Earth.